All right, guys, my name is Taylor Sanz. I am the CEO of Life Goal Wealth Advisors. Today, we are going to discuss the value of alternative investing and why ultra high net worth folks are loading the boat. To start, I've got 400,000 subscribers on Instagram and TikTok where I put out daily content like this. My firm has raised over $150 million in 2024, largely from ultra high net worth clients looking for alternative expertise. In my former career, I spent over a decade on Wall Street at the firms that build these alternative investments. I have a CFP designation, a SEMA designation, and my partner has a certificate from Harvard specifically in alternative investments. First, let's look at what they do to a portfolio. The traditional stock and bond blend doesn't matter what you look at, 80-20 in an aggressive investor, 60-40, 40-60, with the inclusion of alternative here in gray. Every single one of these portfolios sees higher returns on the y-axis with less risk on the x-axis. I don't have to make much more of a point than that to make you realize the power of alternative investments. This is 34 years of data straight from JP Morgan. So let's start with the challenge. Let's look at value in the public markets. So over the past 10 years, the S&P 500 has averaged 13.5% per year. It's been a rock star run. Now looking forward, the next 10 years forecast from the big firms, BlackRock is saying 6.2% per year, JP at 5, Vanguard at 3.8, Goldman at 3. What is going on? Why are they expecting a quarter to a half of the rear view mirror's returns looking forward? That's a function of where we're coming from. So this is nerd terms, but price to earnings ratio. Suffice it to say, when price to earnings ratios are high, stocks are expensive. When they're cheap, or when they're low, stocks are cheap. That's when Warren Buffett's loading the boat. Let's focus on the right-hand side here. On the x-axis, stocks are cheap over here. They're expensive over here. And what each one of these data points is a point throughout history, and they are the starting point from a price to earnings standpoint, and what they correspond with on the y-axis is the next 5 years worth of average annual return to the S&P 500. So boil this down, when stocks are cheap over here, this is when Warren Buffett's buying because there's blood in the streets. Shut your mouth, close your eyes, buy stocks. The returns are going to be solid. When stocks are more expensive out here, prerogative looking forward is not quite as good. Right now, we sit in a top 4 percentile. Most expensive stocks have been throughout history. When you run that line across, it says the next 5 years, if history is any indicator, the S&P does about 2.5%. History doesn't repeat itself. I get it, but it does rhyme. And it makes these numbers now look not quite so crazy. Now, before we move to the next slide, I will also speak to this. Valuations are not the world's greatest timing mechanism. So you're looking at the same exact information over here, but just looking forward 1 year. And you will see there are times when stocks are stupid expensive, and yet they still rock and roll for a 1 year period of time. But over here, there are no aberrations where stocks do phenomenally well 5 years out from a really expensive starting point. So if you're a great market timer, time it, baby. But the old Wall Street adages, the Market Timing Hall of Fame has 0 members. So that's the public stock market. It looks to be squeezed out of a lot of the value that may have been once there. Now let's look at the public bond market. When you're looking at bonds, there's no price to earnings ratio per se, but the way to perceive value in the bond market is what they refer to as the spread. And the spread refers to you take the respective duration of a treasury. If you're looking at a 10-year bond, take a 10-year treasury bond, yields 4.5%, whatever, and then it applies a spread on top. And when spreads are wide, it means there's a lot of value in the bond market. When the lines here are higher, the spreads are wide. And this is investment grade, high quality corporate bonds. And you'll see right now, the amount you're getting paid above treasuries has not been lower since back here in 07, and then prior to that, back here in 98. So that's investment grade, high quality bonds. I'm sorry, these are junk bonds. High yield bonds, investment grade bonds are down here. So it doesn't matter whether you're looking at high quality or low quality bonds in the public market, there's not a ton of value in either one of those two spaces. The last challenge is the fact that stocks and bonds all of a sudden are doing the same thing at the highest rate they've ever done. What you're looking at is a lack of diversification present in the market by way of what bonds and stocks are doing right now. You see right here, as this line goes higher, stocks and bond do more of the same thing in the market, meaning the correlation gets tighter and tighter and the diversification gets lower and lower. So now let's take a look at some of the alternative areas of the market and see if we can perceive some value there. First off, private equity. So what you'll realize to begin with here is this right here, an important point. When you look at companies that are doing over $100 million of annual reoccurring revenue, these are big companies. 86% of them are private. So when you're buying public stocks and public bonds from corporations, you're only buying from 14% of the total pool of assets. And what you'll see here is this has dramatically changed over the years. The purple here is the number of publicly traded companies in the United States. And what you have here in gray or blue, whatever color that is the number of private equity companies. And so companies just aren't going public at the same rate they are in the past. So if you're only fishing in the pond of public companies, you're not getting all there is out there in the market. Now, how about the returns of private equity looking backwards? This is from 2008, when the market crashed, until 2023, the most recent data. And what you'll see here is private equity, broadly speaking, whether you look at the broad private equity category or venture capital, has outperformed the S&P, the Russell 2000, that's small caps, mid caps, international stocks, emerging market stocks, and then also this of the public bond market, which is the Bloomberg Barclays aggregate, which is essentially the S&P 500 of bonds. The other thing of note here is that when people think private equity, a lot of times they think venture capital, which is certainly a portion of private equity. That is your tech startup company that is a boom or bust kind of grand slam type swing. And those can be great, but they also can be a dumpster fire as well. So it's a real hit or miss type opportunity. There's also another section of private equity that's referred to as middle market buyout. And those are a lot of those companies we referred to a minute ago that are doing 100, 200, 300 million dollars of annual recurring revenue. And maybe it's a generational based business where the next generation that's taking it over just doesn't want to run it anymore. And so they say, hey, we're going to sell this thing up into private equity. And a private equity buyer may be a company that has 3 or 4 companies that already look really similar in the portfolio. So what they'll do is they'll buy up that company that has that real consistent reoccurring cash flow and say, hey, let's trim the fat and bring the synergies of these 4 or 5 companies together. And that increases shareholder returns over time. Now let's think about things from a valuation perspective. So here's private equity, and what you're looking at here are multiples of EBITDA. And so what you see here is somewhere between high 8s to 12 in the kind of thrill of 2021, and then back down to 2023. What I want you to take away here is private equity is still selling at a discount, a meaningful discount to what it was during the just post-COVID boom that we saw in 2021 when markets were euphoric. Okay, so that's what we're looking at over here. What you're looking at over here is the S&P 500 trading at 22 times earnings with really expensive stocks right now. And maybe there's still market value to be had there, but there's no argument that 22 times earnings is not richly valued, at least on a historic basis. And we know that when you look at publicly traded stocks, they're currently at about a 25% premium to what they were in 2021. So they're working off the same economy, private equity and public equity. So this tells us one of 2 things. Either public equities are overvalued or private equities are undervalued, or some combination thereof. So that's private equity. Now let's flip the script to the bond side, private credit. So what you're doing here is private credit is lending to those same companies, those companies that aren't public, right? So what you'll see here are the yields on offer in the private equity market. So direct lending at 12.3, global transport here, mezz debt here, high yield, this is publicly traded debt. Preferreds, these are public, but all these areas in gray are the alternatives area of the market. And you see down here, the S&P 500 currently yields 1.2%. So anytime you're thinking that there might be more compressed returns out of things like stocks in the future, yields become more and more attractive because they become a bigger and bigger percentage of total return. Total return is a function of 2 things. asset price appreciation or depreciation, and the yield. And so if you don't expect a ton of asset price appreciation, obviously the yield becomes so darn important because that's going to be a large constituent of where the returns come from. So here's just an example of a portfolio, what it might look like. And this is literally a portfolio that we're utilizing for a lot of our clients in the private credit space. So again, just a reminder here, when you're buying public bonds, you're only accessing 14% of the market, 86% are non-public companies. And when you're buying non-public companies, there's more work on the front end for the lender to lend to those companies. And for that, you need to be paid. So this portfolio currently yields net of fees 11%. And you see here, underlying credits, 3,700 credits. So you don't have idiosyncratic risk of one company defaulting and not making their payment and your investment going kaput. The other thing that comes along with this is that 96% of the names in the portfolio are first lien exposure. This means you are the first person that will seize the asset in the event that they are not able to pay their debt obligations. So if this company is building out a factory, okay, that factory, they aren't able to then pay their debt on that factory build out, then it is seized by the portfolio, and at least you have that as collateral. You don't want that to happen, but at least it's a better worst case scenario than not having it. The other thing I'll mention here is when you think about traditional bonds, the downside to them is that interest rates go higher. There's an inverse relationship between interest rates and bond prices typically. And just think about it from this perspective. If you own a 10-year treasury at 4.5% and interest rates go up and therefore they issue new bonds at 5.5%, what do people do? They sell that 4.5% yielding bond to buy the new 5.5% yielding bond, driving prices lower. So higher interest rates on typical traditional bonds are not a good thing. That said, when you look at this slug of underlying private credit, this is floating rate in nature. So what you have here is as interest rates go higher, the yield you get paid on this underlying investment goes higher. Think of it almost as an interest rate or inflation rider on the bond and the payment that it pays out. But here's the important point. Look at the returns, and past performance is no indication of future returns. Let me be clear on that. But here are 5 years worth of data that you can look at month by month returns. There are three. 1, 2, 3 underlying negative months. Now these two barely even count because they're down less than a quarter of a point. And this is the depth of COVID. This portfolio was down 215. The S&P 500 was down over 20% that month. So it looks really negative on that chart, but if you patch it up against the S&P 500, it's not so bad. And when we think back to what those big firms were forecasting, somewhere between a 3 and a 6% return, if you can sit in a portfolio like this on your hands and yield 11%, and maybe even hope for some dislocation in the stock market, then you could rotate out of this into public stocks potentially. This is a really nice place to wait and see, if you will. So that's private credit. Now let's move into infrastructure. So infrastructure is now becoming a massive play on the back end of AI. AI uses an absolutely exorbitant, incredible amount of energy to power the back end of these data centers. For context, Meta is building a Louisiana facility right now, or has announced the build out of a Louisiana facility that will be enormous. They need to build 3 power plant substations around the outside that they'll have the ability to produce enough energy to power 1 million US homes. But their only job is to power that particular data center. And you'll see here, data center is just going to continue to chew into a massive percentage of the overall breakout of US energy production. And so the energy infrastructure thing is a white hot need in the market right now. You can play it from two sides. You can play it from the debt side, or you can play it from the equity side. So let's look at the debt side. So first and foremost, a portfolio we're using for a lot of our clients currently yields 11.6. So that is the yield. Again, I'll reiterate that those big firms are forecasting somewhere between a 3 and a 6% annualized return. They might not be right. Warren Buffett's selling stocks as well, and there's a reason for that. So this is yielding 11.6. Now, again, if bond prices do nothing but go sideways, you clip that yield, 11.6. So now when I hear 11.6 and I know the 10-year treasury yields 4.5-ish%, it starts to ring some bells and say, hey, what's the level of risk here? Well, when investing in bonds, the big risk to a portfolio is default. So what you see here is the historic default rate in the infrastructure space. It's 1.2%. That is really, really low default rates. And then you look at that relative to non-financial corporates at 14%. So this is really nice risk-adjusted return on offer in the market right now. Now, why is that the case? And you have to realize again, the big need being we need to be able to create more energy in our country to source these AI data centers. And so a lot of these contracts are what they call PPIP relationships, public-private partnerships. So the government structures the contract and brings a portion of the capital to the table, and then they look for private investors to bring the remaining capital to the table. Well, if the government knows their golden goose, paying tax receipts, are the big tech companies and all their underlying employees, they need to continue to be able to proliferate. And we need, as a country, more energy build out to allow that to happen. So the government is structuring really attractive returns in this market to attract capital so we can build out that energy. Now let's look at the equity side of things. So what's really important to understand about alternatives is how they fit in the broader portfolio scheme. So likely they'll be owned in concert with stocks and with bonds. So your alternatives better darn do a different job than stocks and bonds. Otherwise, they're not a diversification agent. And so what you're looking at here are the 10 worst quarters for bonds over the past 20 years and the 10 worst quarters for stocks over the past 20 years. Rising inflation eviscerates bond prices. That's the worst thing for a bond portfolio. Now, bonds are a lower risk asset, so within the worst periods of inflation per quarter, bonds are down 1%. But look at private infrastructure equity. It's up almost 4%. So boom, check the box. You are now diversifying from your bond portfolio. Over here, much more meaningful on the downside is the 10 worst quarters for stocks. The global equity market down almost 15% within a quarter. Look at private infrastructure over here. Positive. Now, it's not hugely positive, but nonetheless, it's positive as your equities are sucking wind. And now, if either one of these two scenarios plays out and you want to take a little cream off the top, sell this and buy over here, stocks on discounts, then that's a great portfolio construction kind of decision that you're then able to make. But if you didn't have that dry powder with an asset class that's maintained or gone up in value, you wouldn't be able to take advantage of stocks as they become dislocated like they did there. All right, so that's infrastructure. Now let's move into private real estate. And you have to understand private real estate has been a four-letter word in the investment world. It's been one of the very few areas of the market that you have not wanted to be over the past few years. And why is that? Because people went home during COVID and they did not go back to the office. And we'll speak more specifically on office here in a second. But what you have here is the global private real estate market returns. And in gray, you have the income generated, and then in blue, you have the depreciation or appreciation. And you see massive depreciation right after the global financial crisis. That was a real estate driven game. And so no surprise there. And then you see largely positive returns until whoop, right here. And this is the big COVID crash in the real estate market. But what you now have is value potentially there. Now, is it everywhere? No, I wouldn't make the argument that it's everywhere. But if you break it down, broadly speaking, into four categories: industrial, office, retail, and apartments. What you see here is the only one where you have vacancies picking up to a meaningful degree here is an office space. And that's no surprise, right? People are working from home. But everywhere else, you see retail right on the screws of long-term average, apartments right on the screws, and industrial significantly beneath that. And then the kicker on that is the demand is still there outside of office where vacancies have picked up. This is showing structural demand continuing. Over here, what you have is construction, new supply to the market. So look at multifamily housing. New construction starts have fallen off a cliff. Okay, industrial construction, boom, falling off a cliff. So we know by the numbers that multifamily housing in general right now is structurally underbuilt in the United States. So if we know that and there's no new supply coming to market, landlords have the upper hand there and then likely can increase rents over time. That's just a supply demand function. And then I don't know about your community, but my community certainly is seeing no less Amazon packages showing up at our house. And that's industrial warehousing that's being depicted right here. Now, the interesting thing about alternatives is it is really, really crucial that you are picking the right alternatives. And that is not the same when you look at large cap equities, which is what everyone buys globally. You'll see the lower quartile and the higher quartile performance is razor thin, the discrepancy. That just means that there's not as much added value in picking one manager versus the other. The same in the global bond market, the same in the US real estate market that's publicly traded. But you look over here and you look at non-core real estate, this is private real estate, you look at private equity, you look at global venture capital, and you look at hedge funds. And wow, it really pays to find the right player in the space because the difference in returns is nothing short of astronomical. And at the end of the day, I don't know anyone that doesn't want to invest like wealthy families. This is right out of Barron's article, and it shows that family offices over $50 million invest 41% of their assets in alternatives. And the nice thing about alternatives is that historically they were for family offices, for ultra rich folks. But the barrier to entry has come down so meaningfully with different vehicles that have now been produced in the market that weren't present there in the past. And so there's access to a much wider swath of people. You don't need to have $50 million to enter that market, and it still serves the same diversification purposes. One of the things I will say when it comes to alternative investing, everyone wants to invest everything in an ETF. And granted, I feel that ETFs are, for the most part, the best way to access the market. They're low cost. They have huge tax advantages that not very many financial advisors or individuals understand. So yes, on the whole, ETFs are a great way to invest in the market. When you do not want to own an ETF, is in a less liquid area of the market. So take real estate as an example. If you and I and 20,000 shareholders are pooling our money in an ETF, and then the manager is going out and buying real estate, and they're outright buying multifamily housing, industrial warehousing, properties, real properties. You know real estate's not liquid. So what happens in an ETF that can be sold any day of the week when the next day half the shareholders say, give me my money back? It doesn't work. You can't flip that property back onto the market and get capital back to the investors and pay it out. So what happens in liquid ETFs is oftentimes when they're investing in less liquid areas of the market, like real estate, those ETFs are out there, but oftentimes they're sitting on a huge buffer of cash to create that liquidity when needed. So when you're investing in a less liquid asset like real estate, like infrastructure, like private debt, private equity, you want to use a less liquid vehicle. And then lastly, I'll just reiterate the point to begin with. The power of the use of alternatives is nothing short of astounding. Every one of these traditional portfolios, 80-20, an aggressive investor of stocks and bonds, 60-40, 40-60, every single one of these gets better with the inclusion of alternatives. Gets better meaning higher returns with less risk. Again, this is JP Morgan statistics going back 34 years. I don't know anybody in any business that does not want higher returns with less risk. Past performance is no indication of future returns, but this is something that's pretty darn compelling. And that is why a lot of folks are coming to LifeGoal in order to help them build out their broader portfolio with the inclusion of alternatives to create a more predictable return stream over time, which is what wealthy clients tend to want. So if you want to chat with us at LifeGoal, click the link in the caption in the show notes, and we would absolutely love the opportunity to speak with you. And we promise we will not waste your time. We will educate just like we did today. Thanks so much, guys. And also, last point, for daily shorter form content, follow us at LifeGoal Investments on both Instagram or on TikTok. And I will put a link in the show notes to that as well. Thanks so much, guys. We'll talk again soon.